Hello and welcome back to Fin 340 Real Estate. This should be Chapter 25, Lecture 5, Part 2. In Chapter 25, we're going to be looking at real estate investing, benefits of investing in the real estate, depreciation and capital gains and at-risk rules on those, equity buildup, and leverage. Today we'll be using a little bit of the whiteboard as well, so it's important that we keep up to task on how to calculate things in this class, and so we'll be doing that on the whiteboard. So the benefits of investing in real estate is that it can make you extremely rich. That's the major benefit that many people go for when they're looking to invest in real estate. No other asset class has produced as many millionaires as real estate has, or probably even billionaires. So it's a very lucrative business to get into, and we're going to show you a little bit of that today. Mostly these benefits can be attributed to the following: appreciation of the property value, a reduction in the mortgage, tax shelters, and rental use and income. So let's talk about the appreciation of the property value. If the property's value begins to grow over time, then it is appreciating in value. And that happens naturally as the price of goods go up through inflation. All real property also tends to keep itself with inflation as well. So it'll grow at about 3 to 4% per year, depending on the area. And then you also have supply and demand in the market, which can increase or decrease the price of the house or homes or condominiums, etc., in the area. Based on those factors of typical economics. Mortgage reduction is when you purchase a home for a mortgage and you use the rental income from the property to pay down the mortgage. Over time, you'll owe less and less on the mortgage value, and so you have less of a mortgage to count against your equity in the property, and eventually you end up owning the property 100% outright. Next are tax shelters, which are provided by the investment in real estate. Both, whether you're not, you can get to tax shelters if you're not going to invest for the purpose of obtaining income, but living in the property. As we mentioned before, you get a deduction on your taxes for paying mortgage insurance, or interest rather. And so you can also do that on your investments as well. You get a deduction for paying interest on your mortgage. It also helps that you can deduct a large portion of the expenditures that are related to maintaining the property and rebuilding it if necessary. And you can also take some money back, as we mentioned before. If it's a historical property, you can get a little bit of a discount on your taxes for that as well. So real estate has large tax shelters involved in the property, and you only pay on the profit in the investment because you're usually going to incorporate yourself to make sure that you are going to be protected from any lawsuits. And then there's the last item, which is the rental use or income use, okay? And that's generally where people derive most of their investment income from real estate, although appreciation is pretty significant over time. Rental or income use is the item that's going to be used to calculate the value of the property or how much you should spend on the property. And one of those metrics that we need to know is cash on cash. So the way this is computed is you take the cost of the property and divide it by the net spendable cash that is produced per year. So if a property produces net spendable cash of $5,000 and its cost is $50,000, the cash on cash is 10. So 50 divided by 5, 10, factor of 10 there. Okay. Now, what is net spendable cash? Net spendable cash is the cash flow in other terms. It just simply means you take all of the rental income, you subtract all of the taxes, interest payments, and any other maintenance costs that you incur, and everything that's left over is net spendable income, everything that you can use for profits out of the business or to pay down the mortgage value. So that's where we get this cash on cash number. In general, cash on cash can be seen as the return on the property. So if you take 1 divided by the cash on cash, then you're going to get a factor as a percentage. So in this case, it would be 10%. And that is the annual return you get on the cost of the property investment. Although technically speaking, it is ROA, not ROI. So it's not an amazing measure to look at. You would rather look at ROI, which we're going to take a look at here in a little bit. But ROA is a good way to say it is a little bit profitable for the property itself, regardless of how I finance it. Depreciation is something that you should all know how to do, either from B Corp 340 or accounting 201 and 202, and it's not any more difficult here. You just have a few things to keep in mind. Straight line is required. You cannot use double declining balance anymore unless the property was previously accelerated under double declining balance or maker's schedule before they changed the law. I believe it was in 1987. So you have to use straight line now in order to do that. Okay. The useful life for all real estate properties is 27.5 years, unless there are improvements made to the property which extend the useful life of the property, but hire an accountant, they will deal with that for you. You should just know when you're computing forecast for the value and you need to account for depreciation, you use 27.5 years to do that. The only item that is included in the calculation of depreciation are fixtures or improvements upon the land and not the value of the land itself. Land cannot be depreciated. Only buildings and improvements upon the land can be depreciated. Subsurface rights also cannot be depreciated. They can be depleted, not depreciated. So if you mine or drill the subsurface rights and take value out of them, then you deplete the value of those assets over time, but you do not depreciate them. So again, the only thing that can be depreciated are improvements upon the land itself. So you take the cost of those improvements, those fixtures, and you divide them by 27.5, and you get the annual depreciation cost. If you were to make additional repairs to the property, you would figure out how much more that would extend the useful life of the property. You add it onto the bottom, and then you add the cost of those repairs to the top. The top then becomes as well the previous cost balance. So what is your carryover balance from the prior year? It does not revert to the original cost of the property. It's what's left plus the new repairs divided by 27.5, or what is remaining in the useful life, plus the extension of the useful life as well. But again, you don't need to know how to compute the repairs addition to depreciation. But you do at least need to understand the concept of depreciation, so when you're doing your forecasts, you understand where it comes from, or if need be, how to calculate it yourself. At-risk rules are special rules which apply to investors who are trying to take tax write-offs for properties. So it used to be that you could take $20,000 as a down payment, take $80,000 as a mortgage, and then write off the entire $100,000 of the property, even though you really have no skin in the game. All you serve to lose is $20,000 of equity in the property if you fail to pay the mortgage. Therefore, you're not supposed to be able to depreciate all of the value of the property at 100% if you did not put 100% of equity in. The only exception to this rule is that if it's recourse financing, then you can take 100% of the value. Recourse financing is financing in which the individual is personally liable to repay debt. Now, you may be sitting there going, well, aren't we personally liable to repay a mortgage? You are not actually. A mortgage is secured by the real estate that is backing the promissory note. Recall that from previous chapter. Because it is secured by that promissory note, the real estate can be repossessed in order to make good on the loan. The individual is not expected to unilaterally pay for the loan if it is not paid. They simply just go into default. And the bank cannot come back and seize other assets of the individual. Remember that they have to sue for deficiency judgment in order to get any money back, and they may lose that court case. So it is non-recourse financing for most traditional mortgages. Recourse financing would be the case if the loan was not backed by a physical asset, so you simply got a debenched loan, a check from the bank that they expect you to pay it back, and you personally signed that you were obligated to pay, and there are no assets backing this property. Then you would have a recourse financing, and you could claim 100% depreciation on that property. However, as I mentioned before, there's a tax credit given for rehabilitation. Okay, regardless of the at-risk rules, you can save some money if you're going to rehabilitate property. You will receive a tax deduction for 20% of the property rebuilding cost if it is considered or designated a historical building, and 10% of the building cost if it was simply built before 1935 but not considered a historical building. Be careful, though, with buildings that are on this historical register. You have to get an additional layer of approval for any building permits which you want to do to get reconstruction or renovation within the property. And those building permits have a lot of red tape to go through because you must maintain the historical foundation out. The insides have to remain, the walls at least have to remain historical, and the outside must remain in the same historical condition that it was. You can repair things to keep it in good condition, but you cannot fundamentally alter the building itself. So think about that before you buy any historical buildings. It may not be worth it in the long run. Okay, equity buildup, and we're going to do some calculations here, is when you purchase a property with a mortgage and you repay that loan over time, as we previously mentioned, and that loan gets amortized over time so that it becomes lower and lower, and your home value actually appreciates as well. So let's do a little example here. We have a building on the next page, which I'll show you in a second, when our tenants are going to pay approximately $500 a month in rent per unit. And after we pay all of our taxes, maintenance fee, and management costs, we will earn about $28,240 per year, so-called the net spendable, on this property. And then we'll deal with complications for vacancy later. We're not going to do it today in this section. We'll do it at a later date. For now, we're going to assume that the property is going to appreciate in value at 4.17%. Okay? All right. So here's our property. It's 1441 Fairmont Street in Pittsburgh. It has a cap rate of 7.06%. We'll talk about that here in a little bit. And it is offered at $400,000. You'll see there at the bottom under the highlights that it has 10 2- or 1-bedroom apartments located off of Penn Avenue, so it's not that far from downtown Pittsburgh. It's fairly central. And it's minutes from Route 8, which makes it easy to get to work. And if we had an additional map line here, you can drive from this property in 15 minutes to about anywhere else in Pittsburgh that you need to. So it's fairly central. It has a nice location, therefore we know people will probably want to rent from it. So let's list our facts. There are 10 units available. The building looks a little bit dated, but it's livable. The current tenants seem to reside there. We see them in the parking lot. Okay. The net total spendable computed, given the cap rate, $28,240 per year. Okay, so the way you do that is you take the $400,000 and we multiplied it by the 7.06%. That gives you $28,240 per year. We can also secure this mortgage on $400,000 with 20% down, and we will receive 5.25% interest with prime credit. So it's a pretty good low interest rate, provided we're able to put 20% down. So what do we need to compute or consider? Well, what is the cash on cash? Let's just compute that so we get an example of how to do it. What is the mortgage payment that we would make if we tried to acquire this property? And when might we want to sell the property? Lastly, what is the effective value of the property at the time that we're going to sell it? And what is the remaining mortgage on the property at that time? The difference between the two is the equity buildup. So at this time, we're going to skip over and move to our whiteboard. Okay. All right. $10 units available. In net spendable. Okay. $400,000 down payment. So that means we've got to put how much down? So we have $400,000 is the cost of the mortgage itself, the total value of the property. So we need to put 20% down, which comes to $80,000. Okay, so we need to have $80,000 cash, and the property is going to be 5.25% interest. Okay. Now, what we can originally do here, easy calculation, we are asked to compute the cash on cash. It's very bad A. So the cash on cash, if you'll recall, we take the cost of the property that we need to invest in. So $80,000 is how much we need to put into the property. And we take the cash that we're going to earn from the property each year. So that's $28,240. Okay. And we can compute this ratio here and determine if it's a good investment. So this, it turns out to be, if we were to do this calculation, we get 2.8328. So the cash on cash is 2.8328, which is a very low cash on cash. And if you do the inverse of this, okay, you're going to get a pretty large number. It's approximately, it's not quite, but we'll round it in our head, something like 30%. Okay, we'll put a little tilde so you know it's approximate. Okay, so that's a pretty good deal. That's not a bad investment, and by any stretch of the imagination, it's a fairly large return. But we need to do a little bit more calculation here just to see how everything works. So the next thing we're asked to do is to compute the mortgage payment. So what is the mortgage? Okay. And so we had $400,000 is the cost of the property itself, and we're going to take and put $80,000 down. So the total mortgage that we need to acquire here, $320,000 for the total mortgage. Okay, and I'll just make a little note for you guys there. We'll just put it in. Yeah, it's fine. Total mortgage. Okay, so with that $320,000, what we need to do is figure out what is the price that we're going to incur per month to get this mortgage. Okay. All right, probably the color is going to change here, but that's fine. So here's the equation for that. And you would usually use your financial calculator, and you're going to compute PMT here. So I'm going to write the equation just so you know how it's done. PMT is what we're trying to find, okay, multiplied by this present value of annuity factor. And you should have done something pretty similar to this in B Core 340. Many of you probably had valuation if you were an advanced student in this class. You should know how to do this as well. And then the interest rate here is 5.25, and we want a monthly rate, so we're going to do 12. Okay. And I'm going to have to erase a section here because I didn't give myself enough room, but that's fine. Just fix that 5 and come back to it. So 5.25. Okay, and I will do it down here instead of closing the gap there. So 5.25% divided by, again, 12. So we want to make sure that we keep everything monthly. And then the mortgage is probably going to be a 30-year mortgage. We didn't stipulate that in the instructions, but let's just say it's 30 years. So I'll put it here, 30-year mortgage, okay? And because it's going to be done monthly, 30 times 12 is 360, okay? So I'm just going to write 12 times 30 here and the exponent. And because this is present value, there's a negative here, okay? Now, as you can see, this equation is fairly complicated. And another way that we could simply call this equation is PVAF, this big block here, present value of annuity factor. You can compute it. The interest rate, 0.525. 12 for monthly, okay, and the total number of years, 30. And you can compute that number if you would like. Now, you can also just put into your financial calculator. In fact, that's what I've done. So then you can just know, well, payment comes out to $1,767.05 per month. Okay. So this is our important result here. Okay. So make sure you make note of that in your work, $1,767 per month. Now let's move along the page here. If I can clear this all at once, or just give it a new, we'll just do a new book. I'll save it. Nah. Okay. Now, we'll rewrite that little bit of information there. So we've got the payment here from B, 767.05 per month. And we want to know, well, what is the value, or how long we're going to keep this property? Okay, that's part C. So let's just say that we could actually put whatever we want here. We could do 30 years, we could do 50, but for the sake of argument, we're just going to say 10 years. So let's say 10 years. We're going to keep the property. And then after 10 years, we sell. And we could get into complications of what month did you buy it, what day, etc., but we're not going to. Let's just keep it a simple 10 years here. Makes it easy to do the calculations. So that gives us enough information to complete D. D asks us, what is the value of the property after 10 years we want to sell it? Well, we originally purchased the property at $400,000. And we said in the notes that it was going to appreciate at 4.17% per year. So 1.0417, okay, for 10 years. And this, you should recognize, those of you who've had me or some other professor, as the future value formula. That can also be R, and then to the N. Okay, so the simple future value formula is what we're using to compute here the value of appreciation. Okay, so let's continue on with our computation here. Get back to a color. So what does this number come to? If you sit there and you put it into your calculator, you will end up getting a larger number than most people would expect. Okay, $601.847. Okay, so we've moved from 400 to 601,847 in only the course of 10 years. This is a large jump, but I will remind you that inflation is not that different from 4.17%. It's about 3 to 4%. So this should keep you in mind again. I often say to my classes, always be aware of inflation. It can be very expensive for you in the long run. So this is the value of the property at end of 10 years. Value of the condominium. I always have a problem with condominium. I forget how many I and N's are in it. So this is the value of the condominium at 10 years. And then we were also asked to compute the remaining mortgage. Okay, so switch back to our blue here. Remaining mortgage, we'll do that computation now. So if you wanted to sit there and do this with formulas, it can be done, but the formula extends, well, it would be all the way over here on the page. And I've demonstrated that formula before in my classes just to show how complicated it is. But for the sake of this class, we're not going to get involved in that. We just really want to use our financial calculator to do that. And the way you're going to do that is to do a future value of annuity calculation. So you can use Excel, you can use basically your calculator. If you have a TI-82 or 84, or an Inspire, or a BA2 Plus, or a Casio, you can also do this calculation. So I'm going to write the parameter formula here so we know what's going on. Again, it's the same 5.25% that was on the mortgage. The mortgage is monthly, so we want to make sure that we write that as monthly. So it's divided by 12 because this is an annual percent divided by 12. And we're going to look for the value after 10 years. So 10 times months, 12. Okay, so 120 there. I'm not going to write it, but you can understand that. And then we need to know what was the payment we've been making on this property. Well, that was this guy over here. That was the payment we had been working with. Okay. So this is the payment that we're going to use to pay for this mortgage. And we're looking to see how does the value decline over time. So we start with a total mortgage value of $320,000. Okay. Technically, we're not supposed to put that little parenthesis there, but that's the thousand separated there. So we started with $320,000, and we're going to make a payment every month of $1,760 $1,047.05. Now, when you enter this into your calculator, what you want to do is you make sure that you enter this as a positive and you enter this as a negative. And what the calculator is going to do under future value is take this original present value and subtract out this payment for 10 years of months, and will grow this original present value at the interest rate that we have set over here. Okay? So here are your four factors that you needed in the calculation. You're going to come over here, compute a future value. And this formula, this calculation, automatically computes to you the remaining value on the mortgage if you were to pay your mortgage $1,767.05 per month for 10 years at 5.25% interest. And so what does that number come to? Reminding yourself, we started with $320,000. We're going to end with $262,234.79. Okay? So this is the remaining value on the mortgage. Okay? So now, these two numbers here, very important, these guys. Okay? This guy and this guy. We're going to use them to compute what was the change in the equity buildup. So we've answered A through D. We've got all the information we need. Now we can go ahead and do the calculation for the equity buildup. So I'm going to go ahead and clear this book here, make a new book. All right, I'm going to write down a little bit of a table here. Let's use black so it's easy to read. We call this the baseline. We're going to call this the buildup. Okay, baseline and buildup. And so we're going to have the value of house. Actually, it's a condominium, but we'll just call it the value of the house. And then we're going to have the value of the mortgage. Call it MORT for short. Okay, so the baseline is what did we buy everything at? So that's going to be 400,000 is what we bought it at, and how much was the mortgage that we got on that property? Well, 320,000, and so we're going to end with 80,000, and this is our equity. Okay, this is the equity that we have remaining in the property. I'm going to write the little equations here so you can see what's going on. So 80,000 is what we had when we first purchased the property. Now let's look at what we got after the 10 years. So 10 years has occurred here, and reminding ourselves that, well, we had calculated the value of the home after 10 years at $601,847.79. Okay? And we calculated as well how much did we have remaining on the mortgage? 262, 234 at 79. And what does the difference of those numbers come to? 339. What do those numbers come to? 339, 602, 95. Okay? So now, that's a large change. A very significant change in the value of the assets. How much of a change? Well, if you take 80,000 subtracted from this and then divide them, you get 325% appreciation, which is a very large number for appreciation of the value over time. That's a worthwhile investment in almost anyone's book. I'll give you the calculation on that was minus the 80,000 so that we get subtract the original value. So it's just P1 minus P0 divided by P0, if you remember that from one of your earlier classes. A terrible line. And it's actually 324.5%. Okay. So that's a very large rate of growth on any investment over a 10-year period. And perhaps we want to know, well, how much is that in fact per year? And so we'll reverse the EAR equation. If you remember EAR, effective annual return. Just a reminder, this is what that looks like. R divided by M raised to the M minus 1. Instead, we're going to reverse this calculation. This number is the EAR at this point. Okay, fully compounded, everything good to go. We're going to undo that calculation right here. So we're going to do 425%. We're going to add the 1 on the other side. And then we've got to take the inverse of the M. So this was 10 years. We're going to inverse that. And then we're going to subtract the 1. Okay. And technically, we'd have to go through the M calculation here, but we're not going to need to do that. We've already got it in annual terms, so we don't need to do that here. We could just do 15.56% per year. Okay. So this is a very large amount of return on the investment. And in general, everyone's going to enjoy 15.56% return per year. Nobody is going to complain even the slightest amount for that sort of return. So you can imagine how easy it is for people to start with a little bit of money and then end up being millionaires. In fact, it doesn't take that much time. It's only going to take you, if you do the rule of 72 here, about 15%. What are we looking at? Okay, we're looking at just under 5 years. Okay, just under that amount. So that's a very quick rate of doubling. Remember that the rule of 72 is how fast do you double your investment? So every 5 years you double your investment. That's a pretty good plan to go with. And so we might be interested in keeping with this sort of gig. And keep in mind, you might say, well, we didn't double our investment. This was not double of $400,000. That's $800,000. That's true, but actually you need to look at your equity. Your equity did double, okay? How many times? Well, 80, 60, 320. Did we double twice in the event of the period? Yeah, 5 years and then 5 years. So yes, we did in fact at this rate of interest double twice. So we netted our 320. Okay, so the rule 72 very correct here. 5 years to double our investment at this rate of return. Now again, this rate of return depends upon what you made in the investment, but this is still a very good rate. Now, the additional thing that we did not consider, let me clear this off here. Okay. What we did not consider? Well, we had 15. Come on now. 15. It's changing colors on me. 15.56. Almost wrote 6.5. 56% was only equity buildup. Okay? Only the equity buildup portion. It did not include, if somebody was astute in doing the numbers there on the side, It didn't include the fact that 224,000 per year minus the total sum of our mortgage payments. I apologize for that, guys. I'm writing on an angle here because the writing tablet's on an angle. I'll try to fix that for you. And we multiply this by 12, then we're going to get 21,204.60. Okay, so the total sum of the mortgage payments we're making is less than the total income that we're earning on this property per year. Okay, so how much do we have left over? Turns out to be approximately $7,035.40 per year in additional income that we hadn't put into this calculation. Okay, so again, we put $80,000 into this property. Ooh, now that I've switched the board, I can't draw lines. $80,000 into the property, and we're going to get an additional cash flow of $7,035.40 per year. So we can compute the return on this. This computation, for those of you who are familiar with stocks, is pretty similar to D divided by P. So this is the current yield, okay, or dividend yield rather. Current yield is for bonds. So do this dividend yield calculation if you would like. Computing this over here, we get 8.79%. 8.79%. Additional investment income. So we add these two together, 15.56 and 8.79. That will give us our total return for the property. And as you can imagine, at approximately what? 23, I don't write an 8 there. 24.35%, 24.35% on this property and investment. That's a good deal. This is a very worthwhile investment. And look, that was from real numbers. Okay, I found you a real investment property that is in Pittsburgh. Anybody could go buy it. It was only $400,000. You only needed $80,000 down payment in order to do it. And we found a pretty good investment that we would obtain out of this property. Okay, so always keep in mind you need to do the numbers a little bit, do the calculation. A lot of the investment return on real estate comes from the equity buildup, which is this number here. This is the equity buildup. But an additional amount comes from cash flows not used. Okay. And what you could do with this cash flow, you have some options here. What do you do this $7,000? Well, I'll just make some notes here. You could pay down the mortgage. Okay. You could make repairs. Although, like every good landlord, we're not going to do that because that reduces our return on the investment. So that's why your landlord is always apprehensive to do repairs, because that would increase the original cost of the property for them. So we'll comment it here. Make repairs. Okay. Or if we wanted to continue to expand, let's say that we saved for 11 months. I'm sorry, not for 11 months. We saved for the 10 years. This entire $7,000, okay, we would have approximately $70,000 plus interest on the appreciation. Approximately $70,000 plus interest on the appreciation, not a bad deal. Guess what we can do with that? If you sold the property for $601,000 plus our $70,000 with a bit of appreciation on that, it should have doubled in that time, so we'll have $140,000. Okay. Then you would be at 741, if you want to get technical with me, $741,000 available in cash at your disposal to make an additional investment. And even though it's 10 years from now, I will remind you that the property only required a down payment of $80,000. And in the time period that we had sat and waited, it appreciated by about 50% of real value. So if we take that same appreciation, new homes for similar size or new condominiums for similar size will require down payments of $120,000. Okay? How many of those can you afford? Well, it's a simple math calculation there. 6 of them approximately we could get at, and being able to invest, it's not quite 6, 5 in a fraction there. We could get at and invest in about 5 of these properties. Okay, 5 more condo units. So now we went from 1 condo unit to 5 more. And if we repeated this cycle just 10 more years, okay, so we've gotten 20 years in the future now, then you would have roughly 5 times plus the appreciation of the value you have now, which is something like, I don't know, rough estimate, $4 million. Okay, $4 million in total value, which is not a bad deal. That's a lot of money. Okay, so keep in mind how you work your calculations here. You can turn easily 20 years of time into multiple millions of dollars. Okay? And it's not that difficult if you know what you're doing. You just sit there and do the calculations. You find the right property. You can easily invest in real estate and make some money. All right, let's switch back to our slides here. Okay, so what made it so that we could make so much money on this investment deal as we had just discussed? Well, the real reason was leverage. And you've probably talked about leverage before in your corporate finance class, your B Corp 340 class, maybe some other additional classes. Some of you will have had extensive exposure to it, depending if you were an upper division student. But what we've got here is a little table that shows you if you invest in leverage, it increases your return on investment. It doesn't increase the return on the assets, but it does increase the return on investment. So we take $30,000 investment and we get a $70,000 mortgage. The total value of the property is $100,000. Suppose that we have an annual cash flow of $10,000. The return on assets is 10%. $10,000 divided by $100,000 total value is 10%. But the return on the investment is 33%. $10,000 divided by $30,000. The same can be done if we looked at a mortgage that gave us 20% down and 80% mortgage. Loan to value is 80 there, okay? So in this case, we've got an annual cash flow of still $10,000. Nothing has changed about the property. The ROA again remains 10%, but now the return on investment is 50%, okay? A lot more money. And if we looked at a more deeper situation, let's say we got an HOA, FHA loan, so we're going to get a lower down payment than we would get under conventional mortgage. Then we can get 10% down. We're going to put $10,000 down, take a 90 LTV on the property, loan to value ratio. Again, annual cash flow doesn't change. ROA still 10%, but our ROI is now 100% per year. That is an enormous return on investment. Very, very high. Again, as comparison, the stock market produces only 8% per year on average, although it's going up to like 8.5% now. So 100% or 8.5%. You do the math and let me know what you would prefer. It's a pretty easy game, this one. The only problem is you need to make sure that you have filled rental agreements and you don't have high vacancies. Repairs don't get out of control. You're up on your taxes. You pay your property taxes. You're a good landlord as far as maintenance is concerned, etc. And you don't get sued by not delivering on your duties as far as being a landlord. And then you can make a lot of money. The only other problem, and this is the major problem where people cannot make real estate work, they do not have the cash. So my suggestion to you, if you want to get into real estate, start saving. Save now. $80,000 may seem like a large amount of money today while you're a student, but in a few years, if you have very good saving habits, it will not take you long to acquire $80,000. And look, $80,000 down, you get a nice apartment building, you start earning money on that investment, and before you know it, you'll have another $80,000 saved out of your own investment income and probably from saving from your working income, and you can buy some more properties. You expand, you expand, you expand, you expand. 20 to 30 years, you're a multimillionaire, you retire to Florida, you lead the good life. So this is how this is done. We'll go into more detail in a little bit about how to calculate these. Your Excel is being released tonight for the condominium calculation, so we can get some exposure into how to do these models in Excel. It's not too difficult. Most of the calculations are going to be done for you. Review the calculations that I've just done with you so that we make sure we're good for them for your exam. Have a good day, everyone.